Hi, I'm Doug Heikkinen, the editor of Advisorpedia. Welcome to today's webcast, sponsored by NS Capital. Today's advisor has many challenges. There's commoditization, creating a lack of differentiation, challenges with lead generation, organic growth is becoming harder, there's pricing pressure, and there are challenges with scalability. Many advisors are looking for ways to address all of these. This session, Drive Revenue by Adding a Retirement Plan Offering to Your Business, is one way to do just that. Today's presenter is Lou Day. Lou is the Senior Managing Director of NS Capital. Lou is a proven financial services executive and entrepreneur. He was the president and CEO of Engagement Systems, LLC, which created, developed, and tested Skill-Weighted Portfolio, a turnkey asset management technology platform. Lou is also the president and CEO of Capital Vectors International. CVI was a contributor to new products and platforms that have raised over $20 billion in AUM. Welcome, Lou. I'll turn it over to you.
Thanks, Doug. I appreciate it. What we'll do today is we're going to go over an opportunity to bolt on a new 401k business line to your practice. This data was compiled in 2019 and published last year, which is before the passage of the Secure Act, which we'll discuss shortly. These are the reasons for advisors to add a retirement plan offering to their practice. Stronger client relationships. 87% of 401k advisors receive referrals from existing clients or centers of influence. Wealth management leads, on average 4.95%. Average number of wealth management opportunities from retirement plans, and a diversified revenue source. $74 billion contributions to DC plans with fewer than 100 participants. And that, with that much revenue, going into a DC plan, that creates a lot of revenue for the advisor managing those plans. Cross-selling has been talked about forever in the financial services industry without much proof. The one exception is in the 401k space. Let me share some data about NS Capital. We entered the business in 2013, took 2 years to build, and we got traction in 2015. Since then, 35% of our wealth management AUM came from 401k clients. And 25% of our 401k plans came from wealth management clients. Today, 40% of NS Capital's revenue is from our 401k business line. Let's look at some industry facts. There are over 500,000 plans with over $7 trillion in assets. 85% of these plans are below $50 million. The space is dominated by brokerage, mutual funds, companies, insurance, and payroll companies. This chart identifies the biggest players who dominate, and it should come as no surprise, they are also the most expensive players. This is a typical benchmark checklist from a standard bundled plan from one of those providers. Covers fees, plan design, investments, fiduciary issues. Green is good, yellow needs attention, and everything in red requires action because it represents a breach of the sponsor's fiduciary duty. And what you see here is the state of the small plan market. These are bad plans, and the liability risk for the sponsors is significant. And that's what led to the passage of the Secure Act on a bipartisan basis, I might add. The act was passed to address the fact that 401k plans in the small market are just not getting the job done for companies and their employees. The Secure Act created a pooled employer plan designed for small to mid-sized companies, allowing them to band together to gain scale and leverage to improve the 401k plans they sponsor. It's estimated that 50% of all small 401k plans will be in a pooled employer plan within the next 5 years. And this means money in motion, which has always signaled opportunity for advisors. And we're talking trillions here, probably the most money in motion ever. So why wouldn't every RIA want to be in the 401k business? Because the 401k business is tough, and the barriers to entry are significant and costly. Take a look. I'll name just a few. You got to develop a sales process. There are significant costs to set up staff and systems. It's a longer sales cycle. And you've got to deal with a lack of knowledge in operations and administration that has to be built. But the right partnership can eliminate these barriers to entry. Now we'll introduce what the right partnership looks like. This is the Unity 401k. It's a PEP, that's short for Pooled Employer Plan. The Unity 401k is already at scale with 150 million today, probably 200 million by year end. And scale is a critical component for a PEP to be successful. Here are the PEP dynamics. The opportunity to bolt on a high-quality 401k business to your practice. Using the Unity 401k, an independent pooled employer plan, and the word independent is a critical component. A new business line that requires little or no work or costs. A 50% revenue share with NS Capital. Increasing revenue tied to 401k plan growth. A proven sales process and support services. Works for startups and can monetize existing small plans. And there'll be a degree of exclusivity because we're going to limit it to a select number of RIAs nationwide. A PEP enables multiple organizations to band together into a single plan that streamlines the process of offering and maintaining a retirement plan. Employers no longer need to sponsor their own individual 401ks or absorb the higher costs, risks, and workload associated with that role. Through economies of scale, a PEP offers employers a high degree of support. The PEP is considered a single plan under RIC tax code and ERISA. It eliminates the Form 5500 and related costs. The PEP is the single signer. It eliminates the ERISA bond and fiduciary liability insurance and related costs. It eliminates plan document restatement fees. And it eliminates plan level audits and costs. Risk mitigation, full fiduciary outsourcing. The 402A is the plan administrator. That role is now taken on by the pooled plan provider. 403A, trust and custody. An RIA acts as a 338 investment manager. The 316 fiduciary assumes full day-to-day administration and regulatory responsibility. And this comes with an institutional investment lineup, which is low cost and very high quality. But the employers retain independence for plan design. Everything, all these green checks are all added services that most standalone plans do not have. And they are the direct result of the leverage scale creates. The result, fully integrated end-to-end services at a lower cost. There are 6 components to a pooled employer plan: fiduciary advisor, pooled plan provider, investments, trust and custody, administration, and record keeping. With the PEP, there's full fiduciary outsourcing support in 5 of the 6 components. This is the responsibility grid. The dark checks on the right are all the responsibilities borne by a standalone plan. With the Unity 401k pooled employer plan, the bulk of those responsibilities moves from the employer to the PEP. The Unity 401k uses a tiered approach to accommodate every type of investor. Tier 1 is individual funds. Tier 2 is risk models. And Tier 3 are target date funds. Here's the investment lineup, which demonstrates the power of scale. Assuming 50% of the money is in funds and 50% in target dates, the weighted expense ratio for this lineup is 0.10%, 10 basis points. And everything in yellow are collective investment trusts, which normally require a very large minimum investment. Here's a specific example, the Goldman Sachs Stable Value Fund. The Unity 401k has the institutional share class, which normally requires a minimum investment of $20 million in the fund and a plan size of $200 million. Now, the Pep Cost Advantage. This is a sample bundle 401k plan from a typical insurance company or mutual fund company. $5 million plan, 50 participants. As I said, standard bundle plan. Investments, $23,500. Trading, $19,500. Mostly active funds, which is why. The advisor who is not a fiduciary of the plan, $15,000. Third-party administrator, an additional $3,000. And last but not least, record keeping provided by the insurance company, $22,000. All in, 1.66%, $83,000. And asset-based compensation for the record keeping, which is a ripoff. The Unity 401k, investments, $5,000. Trading, $5,000. A 338 fiduciary advisor for the same $15,000. No TPA needed. Fixed fee pricing for record keeping and the 316 fiduciary administration, $6,700. All in, 0.63%, $31,700. A total savings of $51,300 from the current cost, 62% lower. And that is from day one, and that grows over time. Once again, the PEP offers superior services with a lower overall cost. Here's the PEP Advantage over time, which translates into millions of dollars more for the participants, or another way of saying it is millions less in fees for the insurance company and their salespeople. And this chart doesn't even address the fact that the Unity lineup would outperform. This also shows why Einstein said that compound interest was the eighth wonder of the world. We have a proven sales process. There are 4 steps. Step 1 is an intro meeting to sell the need for a benchmark, which is complementary. Step 2 is the actual custom benchmark. Then moving to steps 3 and 4, the plan facts questionnaire, and then the proposal itself. Partnership compensation. This is assuming that RA's firm's total advisors can bring in, on average, 5 $5 million plans a year. All the plans, through a combination of market returns and employer and participant contributions, are assumed to grow at 16%. The advisory fee is 30 basis points, of which the partner gets half, 15 basis points. In 10 years, this generates an additional $800,000 of revenue. And depending on the number of advisors the firm has, this could be quite conservative. And remember, this can be done with little or no work or cost. Some facts about NS Capital. A focused and experienced RIA fiduciary consultant. The creator of the Unity 401k pooled employer plan in 2021. Currently 27 individual plans, 150 million assets under management, ranging from startups to $30 million. And our 401k plan retention is 100%. These are the 3 steps for an RIA interested in doing due diligence. The point being, there's a lot more to a 401k business line than just the sale. Step 1 is the sales process. Step 2 is onboarding and administration. Step 3 is plan maintenance through education and fiduciary reporting. These 3 steps combined will demonstrate the services needed to support the complete business line. Okay, Doug, that's a wrap. I want to thank everyone for taking the time to hear our story, and please reach out to me for more information. Thank you.
Lou, that was very informative. If you want to reach out to Lou, please contact him directly at lday@nscadvisor.com. Thank you all for attending.